Welcome, guys. Nice to see a lot of people joining in. Please give me a few more minutes, more like seconds, actually, to set up everything nice uh, in an orderly fashion in order for us to start our webinar. I've actually enabled for you the ability to communicate with me via chat. Please send me a message in the chat to see if it's actually working properly. I see Carl joining in, Donna, Eric. Thank you for the confirmation, Kyle, Paul. Thank you, guys. So I assume the chat is up and running correctly. Can you actually hear me loud and clear? I assume that's the case. Okay, give me a thumbs up. And whether you can see the first slide of the presentation. So I'm going to spell it out. It's webinar introduction to trading. Can you see that? That would be nice to get the confirmation. Perfect. Thank you, guys. So welcome, everybody. I see a lot of people still joining in. Okay. Thank you. I'm going to make a brief introduction and then we're going to go straight to the point. Okay. So welcome to another, for those of you that haven't been here before, welcome to T4Trade webinar. We're going to start from the beginning. We kickstarted our series right from the start, mainly because we have a lot of interest primarily. Okay, so we're going to kick off with introduction to trading. We're going to go over super basic stuff. Okay, and as we progress through time, each and every week, we're going to introduce a different topic. Not that different, but it's going to be correlated to the prior ones, and we're going to build the aim anyways of this webinar is to build a knowledge bank where we can, in a sense, kickstart someone's trading journey right from the get-go. Okay, so we're going to go through many stuff. We're going to go over technical analysis in depth, fundamental analysis in depth as well, and at nearing the end of our series, we're going to do together live trading sessions. Okay, so for example, if you log in, okay, and attend this webinar, and you would like us to go over a specific instrument, whether that is gold, whether that is crude oil, whether that is an FX pair, feel free to send it through, and we're going to do technical analysis together and see how we perceive the price action of that specific instrument is doing that time, and maybe we're going to come up with a decent entry and exit point, make a scenario-based case scenario analysis and all that kind of stuff, and we're going to integrate all we have covered thus far in these kind of webinars. Okay, that is going to be nearing the end of the season. For now, we're going to kickstart the whole thing with the super basics, which is introduction to trading. Okay, hopefully everyone follows. Okay, people still joining in. Okay, unfortunately, we don't have much time to spare, so I'm going to go right ahead. For those that are going to enter the webinar later on, I'm going to probably do a small recap. For the time being, let's get started because we're pressed by time. Okay, so introduction to trading is today's topic. This is a quick risk warning and a small risk warning and a disclaimer. I'm not going to go over this legal stuff. The gist of this message, anyways, that you have in front of you is saying, in other words, that this is for educational purposes only. No investment advice or investment recommendation is going to be provided in this webinar. Again, we're doing super basic stuff. This is an introduction to trading. Anyways, okay, so what we will go over in this lovely session. Okay, so we're going to do a brief intro into Forex, more specifically, because we're an FX broker. This is what we provide. This is the majority of trades are taking place in the FX market. It's the largest out of all markets out there, larger than equities market, larger than commodities market. So primary focus will be revolving around FX. Okay, so that would be one. Another topic that we will go over in this session is key trading slang, okay, or key terminologies that you might encounter as a beginner, as a fresh trader in this kind of chaotic environment that we call financial markets. Okay, so we're going to introduce a few slang words in order to familiarize yourself on what are people saying and what they mean by them. Okay, if for those of you that don't know. Anyway, so nearing the end of the presentation, we will pose questions. Okay, yeah, I'm going to pose questions towards you guys in order to finalize in your head what kind of approach you're going to undertake as a trader going forward. And there are a lot of models that you can adopt when you become a trader. So we're talking about, for example, whether you have a bias or a liking or an inkling to become, for example, a scalper or a swing trader or a position trader. That is ultimately going to depend on various parameters. And I'm going to ask those questions that probably is going to entice you to think about yourself. What best suits my personality as an individual, and what kind of path as a trader, what kind of model, what kind of type of trader I'm going to become down the line. Okay. So it's going to be purely kind of theoretical. It's for you to introspectively consider these kind of questions. Okay. So again, another common thing is going to be related thing, is going to be identifying your trading style. There's a lot of it. And what kind of approaches you can undertake when it comes to trading. More specifically, we're going to make a distinction between technical and fundamental analysis. And I'm going to spoil the beans right now. In my honest opinion, my humble opinion, combining both technical and fundamental analysis is going to, I'm confident enough to say it's going to elevate your game to a different level. So you could be able to spot many other parameters and things that go on in the markets, and you're going to have a basic overview and holistic kind of approach at looking at markets and, in a sense, at the end of the day, executing your trading plan. Okay, so it gives you an overview. That's why I feel and I think, and I do believe that it's going to be beneficial for you to go down both the technical analysis route and the fundamental analysis route. Okay, loads of those are two different schools of thought. They have commonalities, but for some weird reason, we see people super specializing on one and avoiding the other. In my, again, honest and humble opinion, I truly believe in the power of combining the two. Okay, and this is the theme you will get from me going down the line with webinars that are going to follow. Okay, I'm going to be preaching that throughout the series. Okay, again, my own personal bias. You might go for technical or fundamental route, up to you. I'm not one to judge or tell you what to do. Okay, it's up to you. So, and we're gonna close the show with what kind of products you can trade on T4 Trade. Okay, so this is the overview. Let's go into the introduction to Forex. Again, Forex is the largest money market out there. Okay, the market in general. So we have approximately 6.6 trillion dollars of turnover each and every day. So you have plenty of opportunities. This is the most liquid market out there. And what we mean by liquid, we're gonna talk about it on a key slang later on. But for the time being, we're talking about the largest market share, in a sense, of things that you can trade out there. FX is the largest. Okay, so what is Forex? It's a valid question. What is it? And how does it work? Let's review a few examples in order for you to comprehend what we're talking about here. Okay, so in a nutshell, the Forex as a word refers to the exchange of one currency with another foreign country's currency. Simple as that. Okay, you have euros and you want to turn it into dollars. You have dollars and you want to turn it into Australian dollars. You have Australian dollars and you want to turn it into South African rand, whatever that is. Okay, that goes into the exchange market, the FX market, as we call it. Okay, so for those of you that know what Forex as an abbreviation stand for, it's pretty obvious. It's right there. So Forex is, in a sense, an abbreviation of two words. First initial three letters, the foreign, meaning different, if you like, and the exchange, for an X, Forex, that's what the name comes from. Okay, exchange rates or FX rates are, in a sense, the things that state the price of exchanging one currency with another currency at any given point in time. Okay, so you can look at it as like the price going up and down, which represents how much you can convert from one currency to another. Simple as that. I'm pretty sure pretty much every single one of you have done a transaction like that in the past. Let's now go into further detail. So fun facts in regards to the FX market. So the foreign exchange market is open 24 hours a day, and it's going live, or it's open 5 days a week. So we have not 24/7, it's 24/5. And the Forex market is the most liquid market out there, with around $6.6 trillion of turnover each and every day. And that $6.6 trillion is could be outdated. Maybe it's around $7 trillion right now. Irrespective of that, we're talking about the most liquid place you can go and actually trade upon. Okay, so let's look at a simple example in order to better understand what we're talking about here. So let's say, for example, that you live in the United States, you're a US citizen, and you want to travel to, let's just say, Japan for holidays. Okay, so let's just say you've outlined your plans, you've booked your tickets, and now it comes down to how much money you're willing to spend there. Okay, so before going on a holiday, you have an exchange rate between the dollar and the Japanese yen standing around the 100 level, if you like. Okay, so in a sense, you can exchange one United States dollar with 100 Japanese yen. Okay, this is before we go on holiday. Okay, and I've introduced here in this example another component, another dimension, okay, to this example in order for you to understand what we mean by exchanging rates and how the whole thing comes together. So after holiday, this is the information you have available in front of you right now, is that one United States dollar equals now 110 yen. Okay, so with the same amount of dollars, you get more yen. Okay, so the question here is, did you make money or did you lose money after you have taken your trip? Okay, and we're gonna make a base assumption here. Let's just say for whatever reason you went to Japan with company and you didn't spend a dime, a dollar. Okay, so you went with $1,000. You have exchanged $1,000 and you made it into yen, which is roughly around 100,000 yen, given that exchange rate we have. Okay, and do you now hold in your pocket yen? Okay, and let's assume that you came back from your trip, okay, and you paid nothing because you had good friends with you spending money for you in order to spoil you or whatever that is. You can make this scenario in your head, utopian scenario, but still we're gonna get to the point. Okay, so the question here is, after we have exchanged $1,000 and we go 100,000 yen, okay, we have spent nothing and we came back from our holidays, okay, and we're now back in the United States with 100,000 yen. We want to convert it back to dollars. Did we make money or did we lose money? Okay, that is the question here. So basically what happened here is that at the end of the day, when we look at FX rates or exchange rates, we have seen the dollar strengthening, okay, while the yen, or that's the other explanation, or the yen weakened while we were on the trip. Remember, one United States dollar gave you 100 yen, okay, before the trip. After the trip, or while where we were after the trip, one United States dollar gave you back 110, okay? So you have more purchasing capability with the same amount of dollars, and that translates into, quote unquote, more yen. Okay, so in this kind of case, yeah, the answer is pretty simple. We saw the dollar strengthening against the yen, but what has happened to our 100,000 yen that we want to convert it back to dollars since we're back on the States? Okay, so before the trip, we exchanged, as we said before, $1,000 to get 100,000 yen. So even though $1 now buys you more yen, okay, this is after the transaction, okay, since we saw the dollar strengthening against the yen or the yen weakening against the dollar, either way, we are currently do indeed hold yen and we want to convert it back to dollars. So since the yen weakened, okay, as the dollar has strengthened, and you have to get accustomed to this interrelationship between the two. Okay, so if one currency appreciates, obviously the other one depreciates. If the one you're holding depreciates, the other one appreciates. This is a relationship, inverted relationship, okay, that these currencies have between each other. But let's go back to the point. So since the yen has weakened, converting our 100,000 yen on US soil now back to United States dollar, we can exchange it with less, okay, when we travel back to the United States or when we're back at the United States, because the new exchange rate between the dollar and the Japanese yen has gone up from 100 to 110, okay? So the new divisor now, the new divisor, yep, is going to be the 100,000 yen that we currently hold in notes, okay, in actual paper, we're going to go back to the United States and we're going to convert it back to dollars. The new exchange rate after our trip is 110. So we divide 100,000 with 110 in order to get back the dollars. You're going to be left with 909. So in a sense, we have lost money purely based on the exchange rate between these two currencies. Okay. And again, this is a quote unquote utopian kind of scenario, because rarely we see this kind of appreciation between the two, or devaluation between the two. The difference is going to be much less. Okay, you're not going to lose $91 after a week. It's pretty much quote unquote irrational. But you, at the end of the day, you need to grasp the concept. So if one country strengthens, the other one is going to weaken. So the timing of converting money from one currency into another currency is of utmost importance. Okay, so the timing aspect is super important. So as you realize, the whole concept of foreign exchange is indeed time sensitive, and this is what we are attempting to do anyways in the FX market. Judge at any given point in time in the FX market, studying two currencies, what is their relationship going to be like in the near future, and if I can judge, or if I have enough chance or probabilities with my side, and with my case, with my bias, that this specific currency pair or exchange rate is going to move to either upside or downside, I go long or short. You're going to see what those means, or buy or sell respectively, each and every pair, extrapolating that is going to go my way, and I'm going to capitalize on this differential between these two currencies. Okay, so hopefully I didn't confuse you. Hopefully this was an easy example for you to digest. Okay, now that was how things work in the real world. Okay, the underlying principle of how things work in the FX market is pretty much the same. The actual thing that is different is the execution thing. And since we have now you have obviously your own trading accounts, this exchange between buying and selling something happens within the system automatically upon your request. Obviously, at any given time, you feel free to do that. Okay, so the execution part is quote unquote different. You know, you don't have to go to the store in order to exchange that. So what you're trying to do, in a sense, in your platform when you trade FX, is speculate. Okay, where the price of this specific pair is going to move towards in the future, and by making your assessment, you tend to either buy or sell, depending on the information you have at that point in time, this specific pair in order to make money. So it's a speculative kind of behavior that is undertaken in the FX markets in front of your PCs when you log in, for example, into your MT4 platform and use these kind of services that the company provides. Okay, so the theory, however, the base core principles are exactly the same. In order to buy something, you need to sell something. Okay, that is the essence, the two sides of the equation. Okay, so you cannot, especially in the FX market, for example, if you're going to go buy or go long, as the slide suggests, if you're going to go long on dollar yen, much like the pair we discussed earlier on, you are buying dollars and you're selling, excuse me, you are selling your dollars and you're buying yen. That's what you do. Okay, and when you sell the dollar yen pair, you are in a sense selling yen and you get back, or you're buying dollars. Okay, this is the relationship. Okay, so since we covered this example, if you have any sort of questions, please send them through. If not, I'm going to carry on. So for now, I see no questions going on with us. So trading slang is the next topic of this webinar. Again, we're going to keep it super simple. We're going to introduce how many 3, 6, and 5, 11 concepts. There are plenty of them out there. We're going to cover the most basic key lingo or slang that you can encounter when you trade in the markets, or at least read articles of people talking about the financial markets. You're going to encounter pretty much these kind of words. So beginning with long and short. Pretty sure each and every one of you are familiar with the concept. So if not, when we say we go long on something, that means we're buying something. When someone says, I'm long 2 contracts of WTI at this kind of price, that means that specific trader or that guy or that gal has bought, okay, crude oil. That means he or she thinks that this current price is not the ideal price, and in the future, WTI, in this example, is going to appreciate in value. That's why you go long, okay? If you expect the price of something going up in the immediate future, and you have many reasons to believe that, okay, according to your own analysis, then you go long. That means you're buying something. If your assessment says, you know what, I believe the relationship between cable is the GBP, the British pound with the United States dollar. I believe GBP is gonna deteriorate in the next week or so because we have UK elections and all that kind of stuff. We expect political uncertainty to arise, and therefore we expect a weaker pound. Therefore, the tradable action that you most likely can undertake is going short. That means selling the contract, okay? Because you believe the pound is going to be weaker than the dollar in the next week. So therefore, you short and you capitalize on the fall if it indeed happens, okay? And the reasons why you go long or short ultimately depend upon your judgment, okay? So the clearer your judgment is, and the more stuff you know, and the more dots you can connect, and the more understanding you have of the financial markets, and you have a holistic kind of view, the more accurate, okay, you could potentially become, okay? It's not guaranteed. It's not written in stone. The market moves most of the times, okay, not all the times, in a kind of predictable fashion, but sometimes we see irrationality or things not moving at the expected direction as we thought of. You see that arising occasionally, time and time again, okay? Markets are not perfect and not efficient, at least that's my point of view. And that's why we trade the markets, okay? You have this chance to make money based on some sort of deviations or divergence that occurs, okay? So the more you know, the better. At least that's my philosophy, okay? So more you study and more you pay attention to what's going on, not only on the commodities front, not only in the FX front, but also on the political and geopolitical relationships between countries. There is a lot of factors that take place and not manipulate, but adjust things in financial markets. So the market is, in a sense, at a constant state of finding the correct value, okay, bulls and bears, or those that go long and short, or those pessimistic and optimistic, they all battle in the financial markets in order to make sure that price meets this quote unquote fair value, okay, at any given point in time, okay? Again, I've diverged a lot. Let's go back to the topic. So we covered long and short. Long means buy, short means sell. Okay, that's it. That's all you need to know. Or bid and ask, same thing. Bid is buying, ask is selling. So bullish and bearish. Okay, this again is our terms representing, or at least they are aim to give you the sentiment, okay, in financial markets of any given instrument. When we say, for example, I am bullish on WTI, on crude oil, or I am bullish on gold, that means I have the expectation, given the things that I know, that I have seen, that I have comprehended in my own head, that the price action, or the price of gold is going to rise to a higher level, okay? So bullish tends to explain or decipher what kind of sentiment we have around things, okay? Bearish is completely the opposite. That means you can think of it like a pessimistic kind of outlook, whereas bullish is an optimistic kind of outlook. But those terms are super, super vague. You can apply bullish and bearish on pretty much everything, okay? So it may have to do with actual price. So when price rises, that means the bulls are in control. That means that specific instrument is undertaken by a bullish kind of tendencies. Okay, same thing goes for bearish. Okay, that's the opposite thing. Okay, it has to do also with expectations. Okay, bullish and bearish. But the same thing, the underlying common theme here is that when we talk about, when we see someone saying, I'm bullish on this, that tends to lead to mean that I'm optimistic that price is going to rise. Whereas when we see someone saying, I'm bearish on that, that means he or she expects that prices are probably going to move to lower ground. Okay, again, it's a method of gauging market sentiment, or at least outlining your bias, whether that is to the upside or to the downside. Okay, so besides that, you have, if you pull up a chart, you can see someone, and you see someone doing technical analysis, you can see there is bullish tendencies, meaning that you see someone has spotted an uptrend in the price action. Okay, the visual illustration you're going to see from the charts. Okay, same thing with bearish. I think that's pretty much covers everything. So lot size, these are super specific terms when you're going to encounter when you start trading on a trading platform. So lot size is the contract size of the thing you tend to buy. Okay, so for example, in the FX back in the day, the lot size was worth 100,000 of whatever currency you were buying. Okay, now you have mini lots that is 10,000 and all that kind of stuff, or any other kind of contract. So it denotes how much money you are actually trading with that kind of contract. It doesn't mean that if I'm going along one lot of euro dollar, that means I'm buying €1 and I'm selling $1. Okay, that's not how it goes. It's 100,000. It's a fixed kind of contract. And if you are curious about the differences and how to find how much does each and every asset, how much lot size is, how much, what number does each and every instrument you're trading on your platform, what kind of lot size it has, you can go on your MT4 platform. You can hit Control and M, gives you the panel right on your left hand side. You can find the instrument you like. You can do a right click and you're going to go to specs, and you can scroll down and you can see the contract size there, the lot size there. But when we're talking about FX, the lot size, when we say one lot, that means usually you're trading $100,000 or euros or pounds or whatever that is, that currency is, at any given point in time. Okay, so 100,000 is pretty much the fixed kind of contract for FX. There are differences, but in many other instruments, but we're not going to go over it. Okay, so lot size is a super technical and minuscule kind of parameter you can encounter when you're trading. Okay, so next up we have majors, minors, and exotic pairs. Okay, again, there are I'm not sure how many currency pairs are out there, but there are a lot of them. So when we talk about, this is a classification, it's a bundling of currencies together. We get the majors, the minors, and the exotic currency pairs. Okay, and now we're going to discuss which pairs go into this category, which go into other category, and what the other ones. Okay, so before we go into the specs, just remember the majors are the most liquid instruments that are paired. So that means these are the pairs that most or the majority of traders are actually trading upon. That's essentially what liquidity means. There is a lot of people speculating about its price in the market around these instruments. Minors are, or in other words, what we call the crosses, are the second largest category, and the last category, the smaller ones, which do have less liquidity, and the less liquidity you have, the more volatility you have, are the exotic pairs. And we're talking about some, for example, Thai baht, or the Czech krona, or the Swiss, not the Swiss franc, the Swedish krona, or the South African real, or whatever that is. Okay, we're talking about currencies from either emerging kind of economies or developing. Okay, so majors and minor pairs are from economies that are indeed the largest around the globe. Okay, most likely, most of the times we're talking about Western kind of societies. Those are the ones with the best kind of economies. So in the majors pair, you're gonna find interrelationships, okay, or FX pairs of the dollar. This is the primary currency that is traded. Okay, the United States dollar, the world's reserve currency. Okay, the United States dollar, you have the British pound, you have the euro, you have the Australian dollar, you have the Canadian dollar, you have the Swiss franc, and the Japanese yen. Okay, so these are the seven. Some may include the Kiwi, the New Zealand dollar as well in there. So most of the times are the Western kind of societies, economies, excuse me, with the Australasian kind of continent. Okay, so these are the relationships of the most liquid and most tradable currencies of those economies. So once again, the United States, Europe, England or the United Kingdom, Australia, Switzerland, New Zealand, Japan as well. Did I miss someone? And Canada. Okay, so these are the major economies. Major pairs are relationships between the United States dollar and all those other 6 or 7 currencies we have mentioned. Okay, so that is the majors. Those are the most liquid. These are the less volatile FX pairs you can trade. Okay, now moving on to the next category, which is the minors, or in other words, what we call the crosses. Okay, so convergence between the two. So these are the currencies of the same economies, of the major economies we have stated. Again, United States, Canada, Europe, the United Kingdom, Switzerland, Japan, Australia, and most likely New Zealand as well. Okay, without the United States in the picture. Okay, so these are the same 7 or 6 or 7 economies without the United States. So we have, for example, pairs that fall under the minus category, which are the euro against the Japanese yen. Okay, so you see the dollar is not in the picture. That's why we call them crosses. You cross out the dollar and you have the relationships between the two. Okay. Another minor pair or cross is, for example, the Australian dollar with the Canadian dollar. Okay, whereas majors, okay, the main category we mentioned in the beginning, with the United States dollar being at one of the two sides, for example, the United States dollar against the Japanese yen, or the euro against the United States dollar, or the dollar against the Canadian dollar, or the Australian dollar against the United States dollar. Okay, the dollar is in every pair of the majors. Okay, and those other 6 or 7 countries, economies, or currencies, excuse me. Minors are the same major economies without the United States. So Europe with the Australian dollar, etc., etc., etc. And now we move on to the last category, which is exotic currency pairs. Most likely, most of the time, it has the dollar on the quote side. Or I'm not going to confuse you anymore. So on one side of the two, okay, you are exchanging dollars with something, as the name suggests, exotic. For example, South African rand, or the Czech koruna, or what else do we have? The Riyadh, or for example, of Saudi Arabia, if I'm not mistaken, or the Argentinian peso with the United States dollar. Those are the exotic pairs. Okay, that's pretty much it. So majors, minors, and exotic pairs are categorizations of these kind of currencies, and there are a lot of them. The thing you need to remember at the end of the day is that majors and most of the minor ones, the crosses, are highly liquidable. Okay, that means there is a lot of people trading them. Therefore, volatility, you can understand the relationship between volatility and liquidity. So the more the more liquid a market is, the less volatile it is. Okay, so it's a direct relationship between the two. So if you have an illiquid market, okay, that means not many people are trading that instrument. Okay, that means that tends to have that specific instrument, or that market tends to have high volatility. Okay, so you can conceptualize it in your own head. Low volatility equals high liquidity. How liquid something is, the less volatile it tends to be. So it's not a direct relationship. I apologize. It's not a positive relationship. It's a inverse related relationship. Okay. So enough about FX pairs. Let's move on to the next key terminology and slang. We have, give me 1 second, guys. We have hawkish and dovish. Most likely these kind of terms usually revolve around, or you're going to hear these kind of terms when we talk about monetary policy. And when we mean by monetary policy, we mean decisions of central banks, or at least, again, it's another way of gauging sentiment. So the more hawkish a central banker is, or the more hawkish a central bank is, that means these policymakers are in favor of stricter financial conditions. That means they, for example, feel that interest rates need to stay elevated because we have high inflation. Okay, these are the hawkish decisions that these guys are taking. That means they are in favor of restricting, okay, the monetary policy, their money supply. Okay, whereas dovish is completely the opposite. That means they are willing to see growth and expansion. Therefore, their monetary policy is going to be set with lowering interest rates. So dismantling this tightness. We're talking about looser financial conditions in order to allow economies to thrive. Okay, so again, these are two polar opposites. Nothing is bad, no one is bad, then the other one is good. It ultimately depends on the state of the economy. Okay, and if you have been paying attention to what has been going on over the past few years across the globe, we have seen, and we can certainly describe what has happened with central banks as acting with a hawkish kind of tone. Okay, that means all of them, pretty much all of them, with the exception of Japan, rushed to raise interest rates to restrict financial conditions because we saw high inflation. Okay, and now that we are nearing, or in some economies we have neared that we have actually came to the end of the restrictive policy because inflation has moved back towards the target. Now we see many economies, much like the European continent or the Canadian as well, economy, going or pivoting towards looser financial conditions. That means reducing interest rates in order to promote growth once again. And you can describe this tendency as dovish. Okay? If you have questions, send them through. I'm pretty sure it's pretty much understandable. So next one is going to be about pips. Again, a super technical definition that you're going to encounter when you trade specifically FX pairs on your platform. So MT4. Let's have a look at the next slide. So in a sense, pip is an abbreviation of percentage in points, and we're going to see what points are. So it refers, in a sense, pips, it refers to, in a sense, the fourth decimal place of any major currency, okay, with the exception of the yen, which is at the second decimal. So if you pull up a chart right now, for example, of the euro against the United States dollar, it's going to be somewhere around the 1.0700, whatever that is. So the fourth decimal place, and there's some platforms that do have fifth and sixth kind of decimals. Okay, the fourth place is always the pip. Okay, so we're talking about the most, quote unquote, minuscule kind of change of price between these two currencies. So as an example, when traders say price has increased by 1 pip, that means that the price has went up by 0.00001. So the fourth decimal place. Okay. So if the price went up by 10 pips, or 1 point, in other words, it looks like this. So you see a shift. Obviously, you know mathematics. You see a shift from the fourth decimal to the third one. That is, in a sense, what we call the point. Okay, so 10 pips are equal to 1 point. Okay, or 10 points are equal to 100 pips. You get the relationship between the two. So that's why we call it the percentage in point. Again, super technical definition. If you hear someone saying, I went long and I'm actually up by 1 pip, you're gonna say that's nothing. No, I'm joking. That means this is the slightest or the lowest or the smaller change between an exchange rate. Okay, pips. Next up, we have up in line safe haven. If you hear someone saying safe haven, a few things may come to mind. Okay, most likely, most of the times when we say safe haven, we're talking about safe haven assets, and such assets. I'm going to give you the assets first, and then I'm going to explain why. Okay, when you hear that the dollar being declared as a safe haven asset, or the yen being declared as a safe haven asset, or the Swiss franc being declared as a safe haven asset, or gold being explained or said to be a safe haven asset, is pretty much what the name suggests. So in times of geopolitical or economic uncertainty, when things go south, when things turn bad, markets tend to react, okay, to news coming up or some geopolitical event taking place that it's adverse. For example, a war or a pandemic, or I don't know, the fear of going bust in the United States stock markets because of banks closing down. For example, if you remember the mini crisis that we saw a year and possibly 2 or 3 months ago. In terms of this kind of uncertainty, when things are feared to go bad, in a sense, people tend to flock to these aforementioned places that we mentioned before: the dollar, okay, the Swiss franc, the Japanese yen, the euro maybe, and gold, okay, and bond markets as well, so yields market. So in times where you see things going south, there is a predictable movement of funds and capital to these instruments, because these instruments have earned their reputation with their swords that they can withstand these kind of unfavorable market conditions. Okay, so the dollar, it's obviously the world's reserve currency, even though it's currently being challenged, or at least it starts to get challenged by the what we call the New South kind of alliances, the BRICS, if you have heard about this in the news. We're not there yet, but it's gonna challenge them. So the dollar has the name of the world's reserve currency because most transactions are actually taking place within the SWIFT system. And you have, in a sense, the dollar on the one side of the equation. So that pumps up kind of liquidity in the market. And in times of unfavorable market conditions, do you see the dollar kind of strengthening because people are flocking towards safety, if you like. Gold is another one. So when economies are feared to be collapsing or are not doing as well, or are entering recessions or depressions, people tend to flock or flee towards gold again, because for some reason, as a human race, we decided that gold is the most precious metal out there, and it acts as a store of value. I'm not going to go into the details here, but that's what we tend to do as human beings. For some reason, gold is valuable to us, or at least we have been long enough here that for some reason we judge gold to be something of value, even though it has pretty minuscule applications out there. Yes, you have jewelry. Yes, you have whatever that is, but you have other metals that do have actual purposes. For example, silver or copper or palladium or whatever that is. For some reason, gold is deemed to be a safe haven asset where traders tend to flee towards to when you have geopolitical uncertainty or unfavorable conditions. Okay, same thing goes for Japanese yen. Has a history. The Japanese economy has a history of going pretty much unscathed throughout volatile conditions, with the exception of the 1997 crisis. And Swiss franc, obviously, the Swiss are famous for their capabilities at maintaining a steady ship amidst high tides. Yeah. So, yeah, that is what we mean by safe haven assets. Okay. Enough about this. Let's go on to bid and ask. Bid, in a sense, is the thing you click on if you want to buy something. Ask is what you click on in order to sell something. You're going to see it on your platform. And the spread is, in a sense, the difference between the price you can buy something with the price you can sell something at any given point in time. If you go into your platforms right now and you pull up, let's just say the order kind of window, you're going to see that there is a difference between the thing you want to buy and the thing you want to, the same thing that you want to sell. Okay. This difference between the two is the spread. Okay. And this is how people make money on this. So liquidity, we commented on this extensively up until this point. Again, the relationship you need to have in the back of your mind is that the more liquid the market conditions are, the less volatility is going to arise. So when you have exposure of large positions in this kind of liquid environment, you tend to not have the same risk or the volatile conditions that you're going to find on an environment that has low liquidity. Okay, so low liquidity means high volatility. High liquidity means low volatility. And you, depending on your personality, you can judge and you can choose which market or instruments you are willing to trade upon depending on your risk tolerance. And this gives us a lovely segue onto going with the risk on and the risk off. Again, these are key terms. When you have someone saying, when you read an article, for example, Financial Times or Wall Street Journal or Reuters or whatever that is, doesn't matter. When you hear someone speaking about, for example, gold, and they say the risk is on, that means probably that markets are fleeing. They're not willing to take much risk. Okay. So they are acting in a safeguarded kind of manner. So they're not speculating as much. Whereas when you hear the term risk off in stock market, that means nobody cares about risk right now. We are into the moment. We're going to capitalize on this speculative rally. And most people tend to block in these kind of equities or indices and push them to high ground. Okay. Risk on, risk off explains the bias, okay, from the market. Okay, so risk on means conservative, cautious stance. Risk off, that means speculative and kind of liberating, kind of all-in kind of mentality. Okay, so again, I see no questions. Perfect. That means we're moving on. So let's we have reached the point where we're gonna ask a few questions in order for you to come up with what kind of style you're going to adopt, what kind of trader you are. And again, I mentioned at the start of this webinar, these are questions directed towards you. You have to introspectively come to an answer. And in order to come to this answer, you need to obviously know yourself and know thyself. That's a lovely words of wisdom. So yeah, as soon as you understand your own biases, what things you like, what things you don't like, you tend to come to an easier and faster conclusion of what kind of trader you're going to become, but what kind of things you're going to be trading as well. So unfortunately, I cannot help you or cannot dictate you what kind of things you're going to be interested in buying. That ultimately comes to you. And these are a few questions that you could ask yourself in order to come to this realization. But again, at the same time, we're going to introduce what kind of types of traders are out there. And again, judging by your own biases, under which category you think or you feel like yourself falling under. Okay. So it varies from trader to trader, obviously, and how much time. And the reason why we have this slide of how much time, because it's pretty much going to dictate what kind of trader you could most likely going to become. Okay, even though you can also scalp and swing trade, and you can position trade, but also day trade, most of the times you're going to have core kind of approach. Okay, I have not met many people that do all of them, again, because it comes down to time. Okay, so it varies from traders from trader to trader, and depends ultimately on how much time you're willing to spend each and every day trading, but also what kind of style you have and whether you have a fixed or a variable kind of work schedule. Okay, so for example, if you are working 9 to 5 and you want to start trading, scalping, maybe not the best kind of approach for you, normally because it needs a lot of time spent in the financial markets, unless you have optimized the whole process and you can become much more efficient at doing it. But most of the times when we're talking about templates here, or types, scalper traders usually tend to spend a lot of time scrolling through charts and looking at price action, and most of the times being heavily reliant on technical analysis and pull up charts and spot short-term price movements, and they're not taking much consideration onto long-term kind of view of what is going on with the market. So they are fixated upon smaller kind of time frames and these kind of time frames in order to get the most of your trading and percentages. You tend to spend a lot of time on shorter time frames and place a lot of positions on with shorter kind of time frames. Okay, so the 4 hours plus and the 2 hours plus in 30 to 1 minute, it roughly gives you an idea of how much the preparation is going to be like, or the actual trading is going to be like. Has nothing to do with how long their positions are going to be held. Okay, so for example, a scalper, as a default, if you're going to be categorized as a scalper, most of the times you're going to be opening and closing positions within either seconds or minutes. Tend to go for too long. A day trader has, by definition, to open a trade, for example, at the market open and close it near the end, or after 1 hour, after 2 hours, whatever that is. Okay, so open and close a position within the trading day. Same thing as the scalper, but the scalper does it in a much narrower kind of time frame. Okay, so maybe from I don't know, 1 minute to half an hour. Okay, I don't know many scalpers that do have that much patience, to be honest, but still. Swing traders, they tend to take things a little bit more relaxed, I'm gonna say. So the time frame of opening and closing a position, it goes around 1 week's days with a few weeks. Okay, so you might have a position and capitalize on the medium or short to medium kind of trends and fluctuations of any given instrument. And usually swing traders dedicate about half an hour to an hour each and every day to see, oh, you know what, is my trade going the direction I want, or do I need to do something? Okay, that means they are devoting less time compared to a scalper. Okay, so position trader is what we call the bag holder. So you buy something and they close it, I don't know, after a year or after 6 months. Okay, they tend to not pay attention to what's going on most of the times. So they may log in for 15 minutes, maybe not within the day, maybe once a week, to see how the whole portfolio is working, purely because they are actually trading the macro kind of level, the medium to long term kind of trends. Okay, swing traders tend to go with the short to medium kind of time frames. Day traders short, scalpers super short. Okay, so again, it ultimately depends upon you how much time you have to trade. If you are working again 9 to 5 and you're willing to spend half an hour to 1 hour, then the most likely kind of path for you is going to be the swing trader or the day trader. Okay, again, if you don't have that much time, you're working 2 jobs, maybe you're going to be a position trader. Now, if you are willing to dedicate yourself to trading and you want to do this as a profession and do it daily and for many, many hours, then possibly day trading is for you, scalping is for you, position trading is for you. The more time you have available for you to study and make your analysis, the more likely you're going to be obviously much more efficient at and profitable making trades, but you tend to fall on the lower end of the time spectrum. So scalping, day trading, swing trading. Okay. So again, this is all at the end of the day, this is all pure theoretical. I've met people that pretty much do each and every one of these things once they spot opportunities, but we're talking about people that have been involved in these kind of market conditions for years now. They know how to trade on a short term, on a medium term, on a long term. They know how to grasp how the whole thing is unfolding on the macro level, on the short term as well, near news releases. We're talking about experience trading. Now, the same is not for someone that starts right now. That's why it is encouraged to at least pick one of these things, depending on how much time you're willing to dedicate on your trading journey, and start slowly by that. And through time, you may be able to alternate between the two, okay, and spot the opportunities on any given kind of time. Okay, you can mix and match, but at the beginning is a little bit hard. So specialization early in the beginning, it's a safe way to go ahead if you like with your trading journey. Okay, so identifying your trading style. This is again a few questions for you to ask yourself. Okay, do you have any favorable kind of instruments you like to trade? I don't know. Do you like commodities? Do you like gold? Do you like silver? Do you like palladium? Do you like I don't know, copper? Are you interested on how commodities market are evolving and what's going on with the commodities market? No. Okay. Do you like FX? Do you see the interrelationship between countries' currencies and what are these countries' economies are doing, and then coming up with an idea of where that exchange rate is going to go to the future? Maybe FX is for you. Or do you like stocks? Do you like keeping up with company releases and new developments? Do you like trading, for example, tech stocks? Do you like financial? Okay, this is up to you. Are you feeling interested in the things you are trading, or are you just merely trading for profit? Okay, what I have discovered from my own experience and journey, or the people I talk with, most people that are indeed tradable and self-sufficient, if you like, the instruments they're actually trading on are the ones that do give a damn about, if you know, understand what I mean. They do feel excitement when they try to find out what's going on with that specific instrument. Okay, some specialize on the FX, some specialize on commodities, some specialize on indices. Okay, they find their niche early on, and they tend to feed this kind of curiosity by learning and practicing alongside. Okay, compared to someone that merely just trades for the sake of it and just making money. Okay, if you find where your curiosity lies, most likely you're gonna add on a little bit of emotional kind of interest to it, and you're gonna be paying a lot more attention to the holistic kind of thing, what's going on, rather than just merely looking at numbers and saying, oh, you know what, dollar yen is at 162, I'm gonna short it now because of it's too high. Okay, it gives you a little bit of more sophistication, if you like, if you unravel, if you come across your interest. Okay, so that's a piece of advice, if you can call it advice. Okay, it's merely an observation. So for example, do you prefer stocks over FX or FX over commodities and futures? Okay, we covered this. Again, this is questions to ask you to yourself. Okay, so it's helpful to identify what interests you the most and stick to your strengths at the beginning. Okay, some people like to be generalists. I'm one of those people. I like to trade a little bit of everything because I find interest in everything for some weird reason. So it works fine with me, I suppose. But I've been doing it quite a while now. So specializing at the beginning, it's my bias is the way to go. Okay, and again, it comes down to preference. Might be trading equities and commodities. It's not. There's no rule that says you can't do that. The odds are in your favor, however, at the beginning, at least, to find out something, become somewhat of an expert to it, understand what's going on, and then if you move on to something else. Okay, and again, it's up to you. These are the questions you need to ask yourself. Okay, so now we come to we're past our time, but still gonna have to finish up. Now we come to one of the most important questions that I feel needs to be addressed early on. Okay, and I gave you my opinion at the start of this webinar. You know already my bias. The question is, which school of thought are you gonna ascribe to? Again, are you gonna go down the fundamental analysis path or the technical analysis path? My point of view, as a generalist, I like a little bit of both, or not a little bit, a lot of both. I wired somewhat my journey to take into account both of them. Okay. And I feel for me, this is beneficial. It might not be for you. You might be a technical expert and you use only technical analysis, or you're going to be a fundamentalist and you're going to look at financial statements and economic news releases and all that kind of stuff, and you find the edge in that. I personally find the convergence of the two to be a healthy mix that gives me an edge. Might not be for you. Okay, so which is better and which one to use? Again, question to you: do you like looking at price action merely, or do you like reading financial statements? Nobody likes reading financial statements, by the way. You just do it because you get the benefit out of it. Unfortunately, it's one of those situations where you chop wood and fetch water. Okay. But still, life is pretty much, many tasks in life are much like that. But still, anyway. So day traders and scalpers mainly focus on technical analysis. I'm not going to call this a fact. I'm not going to call this as a rule written in stone. This is purely an observation. No need to go into fundamental analysis. They purely look at price action. Day traders and scalpers, because the time horizon of their trades is super, super small, they feel that fundamentals are not affecting it. And they are kind of right. But there is a small portion of that move that is actually explained by fundamentals. Okay, so now fundamental analysts are indeed looking, if you're not familiar with the concepts, we're going to do webinars going into the future about this. We're going to delve deep into technical analysis and fundamental analysis. If these are terms you don't comprehend right now, feel free to join the webinars, but I'm going to give you the gist of the story right now. Technical analysis, we talk about looking at price, volume, and open interest. You have a chart in front of you and you do technical analysis on it. You see people drawing lines, using support and resistance levels, finding the chart, identifying chart patterns, looking at individual candlesticks, using technical indicators. For example, moving averages, RSI, Bollinger Bands, Ichimoku clouds, Fibonacci, all that kind of stuff. Those are technical analysis. They are not looking at what fundamental analysis is looking at, which is financial and economic news releases. Okay, so on the flip side of the equation, you have the fundamentalists, which look at macroeconomic factors. For example, GDP or growth of an economy, or output of an economy, or employment of an economy, or consumption. Okay, you have a lot of pillars that fundamental analysts look at, and in this information, once it's looked upon, once it's analyzed, it gives you an edge, because it gives you an outlook on where things are heading from medium to long-term kind of point of view. Okay, so you get the main direction, okay, of how the market is behaving, and you can extrapolate from there onwards how individual asset or asset classes are going to perform on this kind of short to medium kind of horizon. Okay, so they look at, for example, as we just mentioned, GDP releases. Later on today, we're going to have an employment release from the United States, the NFP. Big fuss about that. And this is where you see an economic release, which falls under the category of fundamental analysis, interrupting or at least affecting the short-term kind of technical analysis judgment of traders, because at that time of the release, technicals tend to be affected by it, because technicals are, in a sense, a representation of the belief of the market in a price across time in front of you on a chart. Okay, so if you see a better than expected NFP print in today's session, for example, you reasonably expect to see the United States dollar jumping at the expense of gold. That's a relationship you grasp once you start looking at fundamental analysis, rather than just opening up a chart of the dollar index or whatever instrument you would like. At the time of the release, you're for some reason short without knowing what's going to happen into the future. You see that the current trend of the dollar moves to the south, and you have no idea that the NFP is coming up. And for some reason, you see an NFP print, the non-farm payrolls report, beating expectations, and your short position gets reversed within an instant because of the NFP release. If it's better than expected, the dollar is expected to strengthen. And if you're short, you're going to get burned out like that. So that's the reason why I feel the need to tell you that please do both of them. Have an awareness at least on the fundamentals that actually keep taking place, because the fundamentals are certainly affecting the technicals much more than the technicals are affecting the fundamentals. Okay, so having at least the awareness that something is coming out and understanding what is going to affect what by how much and in what way gives you the extra edge to, at least, for example, stay away from trading the market at that point in time where the release is going to come out. Wait for the release to come out and then trade, okay? Because if it gets you on the opposite side of the trade, most likely you're going to get wiped out, okay? And it's happened to many people. It's happening to loads of people on a daily basis because they lack this awareness of what and how much fundamentals are affecting the market. I'm talking about technical analysts that getting wiped out, okay? Again, my own personal bias. So to sum up, even though we have done it already, fundamental analysis looks at the macroeconomic factors that affect countries and therefore, excuse me, their currencies. It utilizes the economic calendar, and these free available calendars you can find out there, and also financial news releases, whereas technical analysis looks at chart patterns and indicators that give signals for trading, and they use various indicators that gauge momentum. As we just said, price, open interest, and volume. You have also momentum. You have also what we call market breadth and volatility as well. These are stuff that technical analysis looks at, and these are the stuff both on the fundamental and the technical front that we will be discussing in the next upcoming webinars. Okay. So what kind of products you can trade with Tifo Trade? Pretty much each and every currency pair out there. We're not talking about Nigerian nairas and all that kind of stuff. We're talking about not pretty much all the majors, all the minors, and a lot of exotic pairs. Remember the slide we have early on. So, for example, most liquid pairs that traders actually go on and trade on are the euro dollar. In other words, we call this the common. The dollar against the Japanese yen, the pound against the United States dollar, in other words, cable, and many, many, many others. You can also trade metals such as gold, silver, copper, palladium, platinum, all that kind of stuff. Commodities, you have, if not the most known one, pretty much the one that has the highest liquidity, which is WTI, crude oil. You also have the ability to trade natural gas. You have coffee, you have cotton. We don't have lean hogs and all that kind of stuff, or eggs, but pretty much you have a lot of commodities out there as well. Equities, pretty much, if not FX, equities is the next most tradable kind of category of assets. And you can trade, for example, Apple, Meta Platforms, Nvidia, Amazon, and there's a bunch of them out there, not exclusively, but still there's a lot of them. And finally, you can trade also indices. unfortunately, you cannot trade bonds. Maybe in the future, who knows? So indices such as the Nasdaq 100, S&P 500, Dow Jones 30. You can do the French CAC. You can do Nikkei, the Japanese one. You can do Hong Kong, the Chinese ones. You can do the DAX, the German 40. There is the Australian one, the ACX. There's a lot of indices out there. You can find that on the website. And pretty much, yeah, it's an overall kind of a lot of options when it comes to trading. Again, depends ultimately upon you. Please go over the questions and ask them to yourself and come up with what interests you, what you like trading at, how much time you have available to trade, and all that kind of stuff. And the sooner you do that at the beginning, the easier your life will be in the future, at least when you start your trading journey, at least again, from my point of view. Okay. So I don't think we have anything else. So this is the end of today's session, guys. Thank you for watching. If you do have any questions, please send them through right now before I get out. If not, have a lovely weekend, and hopefully we're gonna have a lovely webinar series going forward. I see we have this webinar went too fast, could not keep up. Really? I'm famous for, at least from the people around me, that talk too much. Apologies. Next time I'm gonna take it much slower. Okay. So anything else? Nope. Have a lovely weekend, guys. Take care. Bye-bye.